Hi everyone, welcome to today's video. So there is a lot of news that is going around the Russia-Ukraine war that is going to take place, how it will escalate into the next world war, and how the stock markets all across the globe are going to vanish and all our portfolios are going to become zero very soon. So that is the narrative that is being played out. So through this video, I'm going to present an economic argument as to how different asset classes, cash, gold, bonds, stocks, how do they perform during wartime. We will look at some historic facts, and accordingly you can balance your portfolio by making a more informed decision. So this will be a short but very important video, so please stay tuned till the very end. Before I jump into the nitty-gritties of the video, very quick shout out to our sponsors for today, which is Golden Pie. They are an excellent bond investment platform. In case you are looking to buy bonds, you can go on the platform, check it out. It is India's biggest bond investment platform right now. I have personally used it and I have loved the product. So you can definitely go check it out. You can check the links in the description box as to how you can invest in bonds by using Golden Pie. Now let us understand whether it makes sense to invest in cash, invest in bonds, invest in stock markets during a wartime like situation. So first and foremost, let us understand that if Ukraine and Russia are going to a war and the entire world is going to get embroiled in a war, then does it make sense for us to hold everything in cash? Or how much cash should we be holding? Whenever a major war breaks out, there are three things that happen. One is that there is supply side shock. So supply side shock simply means that all the supply chain gets disrupted, that nations will not trade with each other, movement of ships or cargoes will stop. Similarly, roadways will stop. Similarly, air traffic will come down. So all these things will happen, and the supply side shock will contribute to inflation because there will be fewer goods that will be delivered in the economy. Second key thing, in order to deal with the warlike situation, the government needs to print more money because they need to undertake a lot more expenses. They will have to buy more weapons, make logistical arrangements, and bunch of other different things, due to which they will print more money. This again leads to inflation. Third and finally, there is bond action. In fact, so just to tell you a very interesting story, that during World War I and World War II, government issued something called as war bonds. These war bonds simply meant that your government will come to you and say that, you know what, we are going to fight a war. Do you want to support your nation in fighting this war? If yes, purchase this bond. So purchasing the bond means that if I want to support my nation in terms of fighting the war, I will give my government certain amount of rupee, let's say 1000 rupee, and I will buy that bond from the government. Now, interestingly, that war bond did not pay me, and it was pretty much at a break-even price. But I supported my government by buying that bond. Why? Because of the nationalistic pride. So that is a very brief but interesting history about the war bonds. But coming back to the topic, that all these three actions contribute to inflation. Now, what is inflation? Inflation is the general level of price rise in the economy, and war ends up creating high inflation. Now, you would have seen that post 2020, the inflation in the economy has been very high. Why? Because 2020 COVID also led to something very similar, that there was supply side shocks, there was excess money printing, there was excess bond actions also. So all that has also contributed to inflation in the economy. And as we are sitting, US is depicting very high inflation, India is also depicting high inflation, bunch of other emerging economies are also depicting high inflation. In a wartime also, this high inflation is going to persist. And what is it that you should definitely not do in a high inflation period? You should not be holding a lot of cash. Yes, there are two parts to this. One is that, of course, you need cash for your immediate expenses. If you are holding 10 lakh rupees, then don't convert everything into cash just because a war-like situation is going to break out. Because of high inflation, all this cash will become dust very quickly. It's better to keep your money in different assets that I'm going to subsequently speak about. But yes, when it comes to cash, during a war-like situation, please don't keep your investments in cash. Keep cash only for expenses. Now comes your second option, that you can go and invest your money in a bond market, because many of us would feel that, okay, bond, safer instrument. So during a wartime, if I'm investing my money in a bond, so at least that will not become dust and I will be able to preserve my wealth. Are you correct? The answer is no. So here is a paragraph for you to read. This is a very interesting paragraph. So this was a research that was done by CFRA and CFA Institute. So the paragraph says that on the bond side, fixed income tends to underperform during a crisis because inflation has been higher during war times. Bond returns have historically been negatively correlated with inflation. So all they are simply saying is that if you are looking to invest your money in fixed deposits or any other bond instrument during a period of crisis, because again the return return of bonds are inversely related to inflation. So if the inflation is high, bond returns are low, and if the inflation is low, bond returns typically tend to be high. Now, parking the war discussion aside for a minute here, what is happening in the economy right now is what? That you would have seen that US, very high inflation, almost 7%. India, very high inflation. Pakistan, extremely high inflation. Sri Lanka, Turkey, extremely high inflation. Now, what is happening? All the governments, for example, US government or US Feds have increased the interest rate. Now, they have increased the interest rate. Why? Because they want to bring down this inflation to a normal level, like 2, 3%, 4% level. Now, the moment this equation plays out, bond investments might become very attractive. So that will be a great time to start investing in bond. And again, you can go check out Golden Pie. It's a wonderful platform for bond investing. And there is a series of listed options that you could consider taking your positions in. But yes, to cut the entire story short, in a war-like situation, bonds become a bad instrument simply because of the fact that the inflation becomes really high. In a normal economy, when the inflation is under control, bond becomes an attractive instrument to invest in. So now let's talk about the third asset class, which is gold. Now you would feel that, okay, during a time of crisis, the gold prices will always go up. For example, when 2020 COVID crisis hit, the gold prices went up. Similarly, any type of major crisis in the world that happens, gold prices always tend to go up. So does this hold true during the time of war also? And here is a very interesting chart for you to take a look at. It does not capture all the wars that have happened, but it does capture some of the important tectonic events. So you can see that during Iran revolution, the gold prices went up. Then Iran-Iraq war, again, gold prices went up. Then they came down very quickly. During Iran-Iraq ceasefire, the gold prices went down. Same goes for Iran's invasion of Kuwait. Again, the gold prices came down. 9/11 attack, the gold prices went up. Iraq war, gold prices again went up. So gold prices are really difficult to predict, but there are two very important points that I would like to outline. One is that gold prices are extremely cyclical and long term. Now, what does that mean? For example, right now, post 2020, gold prices have given an uprun. Now, gold prices tend to be really long. So, if they go up for a while. And when they start coming down, they come down quite a lot. And when they start coming down, the prices stay depressed for a very long period of time. So, gold is highly cyclical and it is very long-term oriented asset. Since gold has already given very high returns very recently, I don't think that if a war-like situation breaks out right now, it will give a massive uprun. Now, second key point that you need to remember is that the supply of gold is managed. It might appear that gold just comes into the economy on its own. It just manifests itself. No, actually, governments all across the globe decide how much supply of gold they want to maintain in the economy, and that becomes one of the primary movers of gold. And also from the consumption or demand side, governments are the biggest consumers of gold. So the point is that government decides the supply and government decides the demand. So from that particular perspective, gold is a risky asset right now from an investment point of view to invest all your money in. Keeping a little bit of exposure to gold is fine, but don't bank on gold by assuming that in a war-like situation, gold prices are definitely going to go up. There are absolutely no guarantees, especially now when gold has given such a massive run-up. Now let's discuss the most important asset class that we all are very interested in as to how stocks are going to behave during a wartime situation. Now before I share some historic facts, let me present one simple argument here that the stocks tend to do really badly when there is a danger to world trade. What do I mean by that? If for example Russia and Ukraine get into the war and US and Europe put successful sanctions on Russia and tell them that, hey, you know what, we are not going to trade with you. That stops the world trade or impacts the world trade to a very large extent. That is a bad situation for businesses because businesses get directly hit due to that move. Russia will further put sanctions on US and bunch of other different countries as retaliation. Then more retaliations will come in. Then further lobbying will happen. So that just disrupts the entire business world, and that is what is bad for the stocks. Just because a war has broken out does not mean that these sanctions are definitely going to take place. This is a very important distinction, and let me help you understand this viewpoint by talking the example of Russia and Crimea war. So in 2014, there was a war that broke out and Russia ended up annexing the Crimean Peninsula, which was a part of Ukraine. Now, I am not an international relations expert, but this was a very big world event that took place in 2014. Now, during that time, US European Union, they all criticized Russia's action. They said that, okay, hey Russia, you have done really bad, this, that, shame on you, blah, blah, right? But bottom line is that US and European Union, they ended up putting no sanctions on Russia. Why? Because that would have created a negative impact on both US and European Union also. Now, in 2021, the entire world is reeling through the COVID crisis. Economies all across the globe are in a very vulnerable shape. The world is not going to say that, okay, you know what, we are not going to trade with China, they are polluting the world. We are not going to trade with Russia, they are an aggressor nation. We are not going to trade with this particular country or that particular country. You can't do that because that hurts everyone's country. So that is the argument against imposing trade sanctions. Now, I don't know whether a full-blown war will break out between Ukraine and Russia, but it's very given that in 2014, when the world was still in an okay condition, if US and EU could not put any sanctions on Russia, what makes us believe that in 2022, the world is going to take strict actions against Russia? But let's assume the worst case scenario. Now, if there is a war that breaks out between Ukraine and Russia, what is it that is going to happen? So CFA Institute has done a study on this, both from a short-term and long-term perspective. So let me read that part out. So it says that the report looked at 20 different incidences from Boston Marathon bombing to Pearl Harbor and found that S&P 500 fell on an average by 1.2% on the day of the event. Whenever the war breaks out, the markets react negatively. On the next 22 days, the markets continue to drop, falling an average by 5%. So yes, so markets do go down, no doubt about that. It took average of 47 days to recover those losses, including the Yom Kippur War in 1973, London subway bombing in 2005. The market recouped its losses in just a few days. So this is the short-term play, but what about long-term? While war, of course, terrible and destabilizes, it turns out that conflicts can bolster portfolios. During World War II, Korean War, Gulf War, US large cap stocks rose by 16.9, 18.7, 11.7%, outperforming the average large cap annual return of 10%. In fact, due to some weird reason, the markets go up after a war. The same situation played out in 2014. Everyone was expecting, when Russia annexed Crimea, that the Moscow stock market is going to fall. Guess what? No, it went up. The markets actually celebrated that move. Now again, I am not an international relations expert, but this is what the data tells us. This is what the research tells us. So what is the summary of this entire discussion? Number one thing is that there is no need to panic because there is a very high likelihood that no trade restrictions are going to take place. Even the worst case scenario plays out that Russia ends up getting into a full-blown war with Ukraine. So that is point one. Number two, please don't cut your positions in the stock market. Please don't engage in panic selling. It is just not worth it because even if you pull out money from the stock market, there is no better short-term asset class where you can place your money. Number three, it is good to take little bit of position in gold, no doubt about that. Similarly, you can take little bit of positions in bonds also right now because the entire world is fighting together to curb that inflation menace. And as the data tells us that as the inflation comes down, the bond market typically ends up doing well. So from that particular perspective, please don't engage in rumor-based buying and selling of that stock. I had made a separate video on what led to the actual market fall. So I hope this video helps you understand the entire war situation between Ukraine and Russia better, and accordingly, you will be able to restructure your portfolio. Thank you so much, and I will see you tomorrow.